Okay, welcome or welcome back. What I want to share with you today is some practical examples of how using the tax-deductible mortgage approach can save years off your mortgages. So we're back with our typical house here for a Canadian homeowner, of which we start out with a not tax-deductible mortgage payment. Typically, let's say we've got a $190,000 mortgage, and it's going to take us 25 years at $1,216 a month to make that payment. Do you know that in the first month, that $1,216, you're going to pay down $277 of principal? 25 years of payments will bring you a total cost of $365,000. However, because we're not tax deductible, that $365,000, if you pay 25% tax, is actually going to cost you $456,000 in income, because you have to earn $456,000 and then give up 25% of it to the government in income tax to get this $365,000. Now, if we simply change the financing we're using to a readvanceable, interest-only mortgage, let's look at what could happen. Now, all banks offer these, but some offer better ones than others. There's a couple of products out there that are especially good. So in the first month of an interest-only approach, using the same payment, and all of this, we're going to use our same payment of $1,216. Doesn't matter. We're not going to change the amount that we're putting into the mortgage. We're putting into the process. We're just going to put in $1,216 a month. So if we go to an interest-only approach, in the first month, in our interest-only approach, our principal pay down is going to be $583. Okay? So let's compare that to our $277. This is actually twice as good. Now, what we're going to do then is we start out with our $190,000 mortgage. And in the first year, we're going to pay down $3,000. We would have paid down $3,419, but in our new approach, we're actually going to pay down about nearly $7,000. Okay, so $7,000 in our principal reduction in the first year using our new approach. Same amount of payment, but using the new approach. Okay, so we've paid down our $7,000, and of course what we're going to do then, as we saw in our previous principal illustration, is we're going to move that $7,000 over to here. We're going to borrow it over on this side, and we're going to put it into our investment bucket. So we'll put our $7,000 here. Well, what's that going to do? That's going to yield us an 8% rate of return, and we have a number of investments that do just that kind of thing, pay an income of 8%. So at 8%, that's going to add in another $560 in principal reduction. With me so far? Okay, so now what we're going to add in is we get a tax break, right? Because on our $7,000, we're actually going to have a tax deduction if we're paying 4% interest per year. That 4% interest is $280. That's tax deductible. So we're going to take our tax break, our tax deduction of $280, and we're going to use it also to pay down our mortgage, because what we're going to get is a $70 tax credit. Remember, we said we're at the 25% income tax bracket. So we've got another 70 that we're paying down. So, in our second year, we would actually have paid down this $7,000 twice. Paid down $7,000 the first year, $7,000 the second year, so $14,630 in the first 2 years, which then puts us at 175,370. Now, using our conventional mortgage, we will only have paid down approximately $7,000 in the first 2 years. So $14,630 versus $7,000. So what does that mean? Well, this starts to pick up speed, of course, because once we go to the next year, we put another $7,000 in here, it doubles all of these other deductions, and so on. So, just by doing this, making the same total monthly payments, we're going to pay off this mortgage not in 25 years. We're going to pay off this mortgage in 18 years. Now, if we pay off the mortgage in 18 years, how much cash are we going to save? Well, we're going to save 7 years of payments, which is $160,500. But remember, we're making our mortgage payments with after-tax money. So at a 25% tax rate, you need approximately $200,000 of income to make that payment. So that's what our real savings is. $200,000 of your income that we're going to save. Now, if we did it just in this straight order, let's imagine the 25-year scenario. Imagine that after 18 years, we've got your mortgage paid down, and now you could use your monthly payments to build up some investments over the next 7 years. Well, 7 years of monthly mortgage payments at $1,216 going into a savings plan instead, and add in some growth, and you'd have a very substantial nest egg. So that's the real measurement of the improvement of your net worth. So, just to review, we've got our $190,000 mortgage, which is actually costing us $456,000 of our income at current mortgage rates to pay off, because we're using after-tax money. Whereas we could get this paid down 7 years sooner, in 18 years, saving $160,500 in payments, and or $200,000 of our hard-earned income. All by keeping our payment at the $1,216 a month, but restructuring using different products. So I'm just going to summarize. Usually the question we get is, well, sounds too good to be true. Why haven't I heard of this before? Well, the main reason you haven't heard of it before is because this approach cannot be offered by a single advisor. You require the right mortgage product, you require the right investment product, you have to set it up correctly for Canada Revenue Agency to be satisfied, and you don't generally find all those advisors under one roof. The other thing is most Canadians are going to one of the 5 major banks or a credit union to get their mortgages. And the banks don't give you this approach for a couple of reasons. The main reason is their bread and butter is residential mortgages. They make far more money off a residential mortgage than they do off these alternative mortgage products, the readvanceable mortgages, even though they do offer the readvanceable mortgages. You can get this at any one of the 5 major banks and at some credit unions. But by taking this approach, they would be eating dramatically into their own profits, and their mandate is not to reduce your cost. Their mandate is to increase profitability for their shareholders. There's nothing wrong with that. It's no secret, but that's why you don't hear about it. Now, a number of creative advisors across Canada have teamed together to offer this type of approach, no additional cost to our clients. We bring in the right advisors, the mortgage advisors, the tax advisors, all the rest of it, to make sure everything's in order, and we can save you many, many, many tens of thousands of dollars. So why not check it out today? Request your free report from our website. We can send you out a report that will show you how your numbers would fit into this type of plan. And or give us a call, drop us an email. We'd love to be in touch with you and just discuss with you at no obligation what we could do for you. Thanks very much for listening.